We are now covering Chapter 8 in FIFO Intermediate Accounting, 16th edition. And this Part 1 is going to cover FIFO, LIFO, and weighted average for estimating costs as they flow from inventory to cost of goods sold. Now, when we talk about inventory, we have two types of people that have inventory. One is a merchandiser, and these types of companies normally buy completed goods and they treat them as an asset until sold, and they're in the inventory account, and then when they're sold, they're transferred to cost of goods sold. The other type of company that carries inventory is a manufacturer. These are companies that actually make things, and these types of companies have three categories. They have raw materials, which is the material they buy to make the goods. Then they transfer from raw materials to work in process, where they add labor and overhead type costs. And then when they complete them, they then transfer them from finished goods. They go from finished goods to cost of goods sold. Now, when we're accounting for inventory, we can use the periodic method, which, lucky for you, is what your homework is. And when you use the periodic method, transfers from inventory to cost of goods sold is only at the end of the month after we've done a physical inventory. We book only sales when an item is sold, and costs associated with inventory are kept in separate accounts such as purchases, purchase returns and allowance, and freight in. Those are some of the accounts that you would have. Perpetual, we transfer the cost from inventory to cost of goods sold at the point of sale. Every time a sale is made, there are two entries. One to book the sale, and the other to transfer the costs from inventory to cost of goods sold. All costs associated with inventory go to the inventory account. Regardless of the method used, we must do a year-end physical inventory. What costs do we include in inventory? Well, they're all costs directly connected with the product, including freight in. And remember, freight out is always a selling expense. Now, there are cost flow assumptions. First, we have specific identification. This would be used by like an antique company or a car company or a boat company, where they have every item is unique and they keep track of the actual cost, and when that specific unit is sold, the costs are transferred. Next, we have FIFO. FIFO is acceptable under the international standard as well as GAAP, and it says that the first cost in is the first cost out when sold. FIFO also follows the flow of cost, the normal flow of costs. Under GAAP, we can use LIFO, and of course we have all the different challenges associated with it, which is the last cost in is the first cost out when an item is sold. This is not acceptable under the international standard. And last, we have the average cost. We determine a per unit cost by taking the total cost of goods available for sale divided by the total units available for sale, and we get a per unit cost, and we're going to take that times the units sold. Average cost will always fall between, cost of goods sold will always fall between FIFO and LIFO. So now let's take a look at our example, and what we're going to do is we're going to do it first using the periodic system for FIFO, LIFO, and weighted average, and then we'll use the perpetual system for these methods. We're not going to do specific identification. We're going to focus on these because these are the real challenging ones. So in this example right here, we have the beginning inventory, we have purchases, and we have sales, and we have the prices. Now, the first thing I do is figure out what are my total units available for sale and my cost of goods available for sale. So I'm going to rearrange this information. So what I'm going to do is take the units and when the transaction occurred that are associated with inventory itself times the cost to get the total cost associated with that specific purchase. We had a purchase on 2-4 of 2,000 units. We had another purchase on 4-2. So we have total units available for sale of 6,000 with a total value of 117,000. Now I'm going to figure out what are my total sales. I'm going to take the units sold on 2/20 times $30 and the units sold on 11/4 times 33, and that is the sales, a sales number associated with the 4,700 units that were sold. Now, I'm going to figure out what was the unit, how many units did I have in ending inventory. So I'm going to take my total units available for sale. I'm going to subtract out the units that were sold, and that tells me how many units are in ending inventory. Regardless of the method used, you're estimating the allocation of the total cost of 117,000 for between units sold and ending inventory. And when you total those two amounts up, they should equal the 117. So remember to always do that whenever you go through the process. So, periodic. Cost of goods sold is determined at the end of the month, and it's irrelevant when items were bought or sold. So, for our first one, we're going to look at FIFO. Again, first cost in is the first cost out. And we know that the total cost of goods available for sale equaled 117,000, and the units sold were 4,700. So, what we're going to do is we're going to go through this and say, all right, we sold 4,700 units, and since the first cost in is the first cost out, we're first going to take 1,000 units at $12. Now, we still have 3,700 more units to figure out, so we're going to now take 2,000 at 18, leaving 0 there. So for cost of goods sold, we're going to have 2,000 times 18, and we still have 1,700 left. So what we're going to do is subtract them from that 3,000, leaving 1,300. And now we have our cost of goods sold, and we also have the value of our ending inventory. And when we total those two together, we get 117, so we know we've done it correctly. And our gross profit is going to be the 147,600 that we calculated in the other slide, minus the 87,100 that we just figured out for cost of goods sold. So in this case, we have a gross profit of 60,500. Now let's do the same thing doing LIFO. In this case, though, what we're going to do is we're going to start with the 3,000 units. And that leaves us 0, and now we still have 1,700 we have to account for. And that's going to leave 300 there at 18, and we're going to take 1,700 at 18. So now we have our total cost of goods sold, and our ending inventory is going to be 300 times 18 and 1,000 times 12. And again, they equal the 117, so we know we've done that correctly, and now we can calculate our gross profit. And since prices are rising, if you notice, our gross profit is lower under LIFO, which is what usually you want for tax purposes. Now the last we're going to do is the weighted average for periodic. We're going to take our total cost of goods available for sale and divide it by the total units available for sale, and we get an average cost of $19.50. So our ending inventory is going to be 1,300 units times $19.50. Our cost of goods sold is going to be 4,700 units times $19.50. And now that totals 117. So now we can figure out our gross profit, which is $55,950. Now if we compare the three, if you notice, gross profit is lowest under LIFO, highest under FIFO, and weighted average falls in between. So again, if prices are rising, FIFO will give you the highest gross profit and LIFO the lowest, and weighted average always falls in the middle. Now, what does it look like if we do perpetual? The thing here to remember is that every time we make a sale, so we must take that into consideration, we have to calculate cost of goods sold. Now, under FIFO, whether you do periodic or perpetual, you're going to get exactly the same answer because it's always the first cost in is the first cost out. So when we make our sale of 2,500 units, 1,000 is going to go to cost of goods sold, and 1,500 is going to go to cost of goods sold, and we have 500 left at 18. But when we make our next sale, we're going to take 500 at 18 and 1,700 at 23, and we still get 87,100. And ending inventory is 29,900, and that gives us our 117. And our cost of goods sold would be the same. So remember, for perpetual or periodic, you're always going to get the same answer under FIFO. Again, that's why they like this for the international standard. Now let's take a LIFO, because with LIFO, when you're under perpetual, you're going to get a different answer. So when we make the sale of the 2,500 units, we're going to take 2,000 at $18, and we're going to take 500 at 12. Now when we make our next sale of 2,200, those are all going to be taken out of the 3,000 at 23, leaving us 800 at 23. So to get our ending inventory, it's going to be 500 at 12 and 800 at 23. So we do get a different answer, and we get a different answer for our cost of goods sold. So that's the difference between using LIFO, FIFO. But we still have one more, and that's weighted average, which can be a lot more complicated. Now, when we are using moving average, what we need to do is every time we make a sale, we have to come with the average cost per unit, and we take that times the units sold. Then we're going to take that $16 and we're going to take it times the remaining units in inventory, and that's going to be the value that we use. And then we're going to add our purchases to come up with a new average of 22. That is going to be the number that we use to figure out our ending inventory. Our cost of goods sold is going to be the 88.4, and again it equals the 117, and that gives us our gross profit. So now we've covered all three, periodic and perpetual. So now we can move into part 2 of this chapter. Thank you.